Is Fidelity, Schwab, or Vanguard better? Here's our take after 30 plus years. Hello, Diamond NestEgg members, super savers, and course fans. I hope you're healthy and well. So, as many of our channel regulars know, I've been with Fidelity for a long time. The first time I placed a trade with them, it was with one of these ancient corded rotary phones, and long before commission-free trading was even a thing. But more than 3 decades later, and armed with multiple accounts across Fidelity, Schwab, Vanguard, and other brokerage firms, would we still choose Fidelity all over again if we were to start our financial journey now? Or would we go with another broker? I get this question a lot. So, with that in mind, here are the 3 topics that we'll be covering today. 1. Is Fidelity, Schwab, or Vanguard better based on our personal experience? And even more specifically, in which areas does each broker excel? 2. Which one might you want to start with as a beginner? And is it worth moving your existing brokerage account elsewhere if you're further along in your financial journey? And 3. What are some specific considerations for bond investors? Let's dive in now, folks. Is Fidelity, Schwab, or Vanguard better based on our personal experience? And even more specifically, in which areas does each broker excel? Before we begin, please do note that today's discussion is geared towards your average do-it-yourself retail investor like you and me, not towards those looking for international reach, active traders, or anyone seeking a human or robo-advisor. But if this is you, stay tuned. We'll have something to say about that in future videos. So, here's our Fidelity, Schwab, and Vanguard comparison across 7 categories, starting first with the types of accounts that are offered. Here, Fidelity is the overall winner with 3 check marks, followed by Schwab with 2 check marks, and then Vanguard with 1 check mark. Basically, the more check marks, the better. All 3 brokers offer the standard taxable brokerage account, as well as tax-advantaged retirement accounts, including traditional, Roth, and rollover IRAs, as well as 529 college savings plans. Where Fidelity really stands out, at least for us, is with their product offering of no-fee health savings accounts, teen brokerage and Roth accounts, and business accounts. And yes, in the Lammer family, we have nearly all the different types of Fidelity accounts I just mentioned, with the exception of a 529 college savings plan. And the primary reason for that is that the 529 plan offered by our state offers us more tax advantages. And if it matters to you, Fidelity also offers a crypto account where you can buy and sell Bitcoin, Ethereum, and other digital currencies directly. This is one account that we haven't opened yet, but in case you're interested, do keep in mind that unlike all the other accounts that I mentioned earlier, assets held in a Fidelity crypto account are not SIPC protected. So, Schwab gets 2 check marks. Unlike Fidelity, they do not offer a standalone health savings account, or HSA, but rather an HSBA, what they refer to as a health savings brokerage account. This is basically a self-directed Schwab brokerage account that resides in the HSA that you hold with your HSA provider. And you can only access Schwab's HSBA if your HSA provider allows this option in your plan. Sounds complicated, right? I've linked this Schwab HSBA page below for those of you who might want more details. Schwab's custodial accounts for minors are also more complicated to locate on their website and open online. We really had to hunt for these. And it also doesn't currently offer a crypto account for investing directly into digital currencies like Fidelity does here, although it appears that Schwab does have this planned for later in 2026. And Vanguard gets 1 checkmark because it offers neither an HSA nor a direct crypto investing account. The overall Vanguard experience feels more limited to core investing accounts, in our opinion, which may also be fine if you want to keep things simple. Moving on now to the second category, overall fees and expenses, and specifically focusing on stocks, bonds, ETFs, and mutual funds traded online, as well as general account management costs. Here again, Fidelity is the winner, but then followed by Vanguard and finally Schwab. Despite Vanguard offering some of the lowest expense ratios in the industry on its own funds, there are 2 primary reasons why it did not win this category. First, Fidelity offers 4 zero funds that feature a 0% expense ratio and no minimum investment requirements, making them accessible for beginners or anyone looking to invest in small amounts. Do note, though, Fidelity's zero funds track Fidelity's own proprietary indices that are designed to closely replicate well-known third-party ones, like the S&P 500. For example, if we take FNILX, Fidelity's Zero Large Cap Index Fund, this is the zero fund that most closely mirrors the S&P 500 index, but it does not track the S&P 500 index directly. Rather, it tracks Fidelity's own U.S. Large Cap Index, and this is likely done to keep Fidelity's costs as low as possible for this 0% expense ratio fund. S&P usually charges you if you use their S&P 500 index. What this also means is that Fidelity's zero funds are only available through Fidelity. You cannot buy them on Vanguard or Schwab. So if you were to ever transfer your brokerage assets out of Fidelity, you would have to sell your Fidelity zero funds before doing so. And if you go beyond Fidelity's 0% expense ratio funds, let's take FXAIX, Fidelity's 500 index fund, which does track the S&P 500 index directly. FXAIX's expense ratio is 1.5 basis points. This is half the 3 basis point expense ratio of VOO, Vanguard's S&P 500 ETF, which at the time of this taping is the largest S&P 500 ETF with assets under management of $1.5 trillion according to Morningstar. I should note that FXAIX, like Fidelity's zero funds, is an index fund that trades only once a day at net asset values versus VOO, which is an ETF and can be bought and sold anytime during trading hours. But for the individual investor who doesn't need the real-time access, FXAIX translates into savings of $15 versus VOO per $100,000 investment per year. And maybe these savings can start adding up over time, especially if you're investing for the long term. And speaking about the numbers adding up, so $1.5 trillion in AUM multiplied by the extra 1.5 basis points the VOO charges investors over FXAIX, this equates to about $225 million more in revenues for Vanguard every year. A nice amount, I suppose, even for them. And the second reason why Fidelity beats Vanguard in terms of overall fees and costs. Vanguard has a number of extra costs that you may need to watch out for, such as an account closure and full transfer out fee of $100 and an annual account service fee of $25 if you have less than $5 million in assets with them. Although this annual account service fee of $25 can easily be waived if you opt for e-delivery of statements and other communications. Also, I know that quite a number of our Diamond NestEgg regulars who are or were long-standing Vanguard clients were upset about the account closure and full transfer out fee of $100 when Vanguard first implemented this, and some even rushed to close out their Vanguard accounts before the fee went into effect. In all fairness to Vanguard, Schwab also charges $50 per account for a full transfer out of assets, and for Fidelity's traditional, Roth, SEP, and rollover IRAs, a $50 account closeout fee may also apply. In any case, this overall fees and expenses category, it's important to point out that this is merely our yardstick for assessing relative cost efficiency across the 3 leading brokers, based on our own experience. It's not to say that Schwab and Vanguard are expensive, because in the grand scheme of things, they are not expensive, especially when compared to more traditional full-service brokers. Nor is this to say that every product at Fidelity costs less than its competitors, because we're about to talk about one that doesn't, in our third category, the cash sweep or core position. This refers to when a broker automatically moves uninvested cash from your investment account into a higher yielding SIPC protected money market fund or FDIC insured bank account so that it can earn you some extra interest rather than sitting in your account idle and doing nothing. Here, Vanguard is the winner with 3 check marks, followed by Fidelity with 2 check marks and Schwab with 1 check mark. Any uninvested cash sitting in a Vanguard investment account is automatically swept into VMFXX, Vanguard's Federal Money Market Fund, which at the time of this taping has a 7-day SEC yield of 3.58%. At Fidelity, uninvested cash in a brokerage account is automatically swept into SPACs, Fidelity's Government Money Market Fund, which currently has a 7-day SEC yield of 3.3%. Or FZFXX, Fidelity's Treasury Money Market Fund, which currently has a 7-day SEC yield of 3.31%. Or FCash, Fidelity's taxable interest-bearing cash option, which currently has an interest rate of 1.82%. And that's why Vanguard wins in this category, because the yield on their cash sweep or core position is generally higher than Fidelity's. And the key reason for this is that Vanguard's money market funds typically have the lowest expense ratios in the industry at between 7 to 11 basis points, whereas Fidelity's money market funds have expense ratios ranging from around 30-something basis points to about 42 basis points for retail investors. They do have money market funds with lower expense ratios, but these are usually only for institutional investors or those who have a Fidelity advisor. And Schwab's money market funds normally charge 34 basis points unless you're investing more than $1 million, in which case the expense ratio is 15 basis points lower. But that's not the reason why Schwab has only one checkmark in the cash sweep or core position category. It's because the uninvested cash in your Schwab account isn't automatically swept into any one of these money market funds to earn higher yields. Rather, your cash is directed by default into one or more FDIC-insured banks, what Schwab refers to as program banks, where it earns this very, very low 1 basis point of interest. So, if you want to earn a similar 3% plus on your uninvested cash at Schwab, you would have to manually purchase your Schwab money market fund of choice on your own. And in some instances, you may also have to manually sell your money market fund shares if you want to use them to purchase another investment. This process is not automatic at Schwab, like it is at Vanguard and Fidelity. Check out this money market fund video that I've linked below if you want more details on the money market funds and cash, sweep, or core positions at Fidelity, Schwab, and Vanguard. And if you're sitting on a fair bit of dry powder right now, come on over and join our VIP investment club, where we're talking about 7% bonds and other higher yielding income opportunities right now at the time of this taping. Visit our website after this video at www.diamondnestegg.com and click on this yellow Private VIP Investment Club button to learn more. I've also linked everything below this video for your convenience. We're kicking off our Covered Called member series this coming week. Moving on now to the fourth category, cash management capability. This refers to whether the brokerage offers a cash management account, or CMA, which is a type of hybrid checking and savings account offered by brokerage firms, meaning it is not a bank account. Think of a CMA as a separate spending and or savings account that you hold with your broker. Here, Fidelity is the winner with 3 check marks, followed by Vanguard with 2 check marks, and Schwab with 1 check mark. Fidelity's CMA is attractive for many reasons, including an ATM debit card with no annual fees, unlimited ATM fee rebates worldwide, no foreign transaction fees, check writing and online bill pay, as well as compatibility with Apple Pay, Google Pay, PayPal, and Venmo. The cash in your Fidelity CMA can either be parked in SPACs, which, as I mentioned earlier, has a 7-day SEC yield of 3.3% at the time of this taping and is SIPC protected, or in Fidelity's FDIC-insured deposit sweep program, which has a 1.84% APY at the moment. Vanguard gets 2 check marks when it comes to its cash management capability, because its cash management account is simply not as feature-rich as Fidelity's. Vanguard refers to its CMA as their Cash Plus account. At the current time, Vanguard's Cash Plus account does not offer an ATM debit card, check writing, or overdraft protection. It only works with PayPal and Venmo. Plus, there is a $100,000 limit on daily transactions and a possible 60-day holding period on new funds. That said, Vanguard's Cash Plus account does offer a slightly better rate at the moment than Fidelity's CMA, 3.35% APY, which includes a 25 basis point Cash Plus APY boost through April 30th, 2026. And if you want, you also have the option to park the funds in your Cash Plus account into one of these 5 SIPC protected Vanguard money market funds here. VCTXX, it's California Municipal Money Market Fund. VMRXX, it's Cash Reserves Federal Money Market Fund Admiral Shares. VMSXX, it's Municipal Money Market Fund. VYFXX, it's New York Municipal Money Market Fund. And VUSXX, it's Treasury Money Market Fund. There is a minimum investment requirement of $3,000 per money market fund. And Schwab now. It gets 1 check mark because it does not offer a cash management account like Fidelity and Vanguard. And the reason for this is probably because Schwab has its own bank. Today's discussion is centered around Schwab's brokerage capabilities. But it's worth noting that if you get a Schwab checking account via their banking arm, it will offer pretty much the same features as Fidelity's CMA here. Plus compatibility with Zelle, which Fidelity's CMA does not have right now. That said, Schwab Bank's investor checking pays practically nothing at 1 basis point APY. If you want more details about the cash management offering at Fidelity, Schwab, Vanguard, and even Wealthfront, I've linked our latest best cash management accounts video below for your convenience. Up next, in the 5th category, we have customer service. This one was really difficult for us to rank because 2 out of the 3 brokerages were head-to-head here, no matter which way we looked at it. So this is the first category on the list where we have 2 winners, Fidelity and Schwab, each with 3 check marks. Both have very friendly and knowledgeable 24/7 customer service via phone and or chat. And if there are specific questions that they can't answer outside of non-standard working hours, for example, after the fixed income desk has gone home for the day, you'll usually get a follow-up call or email back the next business day. Vanguard's customer service, on the other hand, is only available on business days between 8 a.m. and 8 p.m. Eastern Time, and there are often complaints about long wait times, which we have personally experienced as well. The last time we called them in 2023, we hung up after 30 minutes, and the last email I sent them about agency bond availability, I never even got a reply. And based on the comments and emails we've received from our Diamond NestEgg community, it appears customer service is a common pain point at Vanguard, so they get 1 check mark here. For our 6th category, we have user interface, tools, and research. This is a fairly broad category encompassing everything from the website and mobile app to screeners, calculators, and investor education. And here again, we have 2 winners, Fidelity and Schwab, each with 3 check marks again. Both of them have websites and mobile apps that are clean, modern, visually appealing, and relatively easy to navigate. We rarely have issues finding what we're looking for with Fidelity and Schwab. And when it comes to tools, Fidelity excels with its robust screeners, retirement planning, and other calculators, as well as portfolio trackers, whereas Schwab has advanced charting, trading, and options capabilities. Similarly, both offer high-quality third-party research, for example, from S&P Global and Morningstar, as well as educational content. Personally, I do find Schwab's research to be more in-depth usually, and just a notch better as a result. Fidelity's research and educational content is also very good, but more beginner-friendly, so it really depends on where you are in your financial journey. Here, Vanguard also gets 1 checkmark only. While they have updated their website and app since last year, it still feels a bit outdated and clunky. Having done numerous step-by-step tutorials for our Diamond NestEgg community across all 3 brokers, Vanguard's platform is just not as intuitive, and most processes take a few more clicks to complete. Their screeners, portfolio tools, and research are also very basic and seem to be geared towards passive index or ETF investing, which, to be fair, aligns with their overall positioning. But it does feel a bit thinner and maybe even last century. Moving on now to our 7th category, security. So we have money with all 3 brokers and feel that all 3 rate extremely high in this area with their bank level encryption, 2-factor authentication, security alerts, and protection against losses from unauthorized account activity. In addition, All three are SIPC member brokerage firms, meaning the SIPC will protect up to $500,000 for securities, including a $250,000 limit for cash in each qualifying account in the event that the brokerage fails and your securities and or cash go missing for some reason. SIPC does not protect you against market losses on your investments, nor does it cover non-security investments. If you want more details on SIPC, what's covered and what isn't, please refer to our latest SIPC video, also linked below for your convenience. Having said all that though, we have given Fidelity 3 checkmarks again, and Schwab and Vanguard 2 checkmarks in the security category. Fidelity's third checkmark comes from its money transfer lock feature. When you turn the money transfer lock feature on in your Fidelity account, you essentially stop outbound money transfers, transfers between Fidelity accounts, transfer of shares and assets to another institution, as well as individual withdrawals. What's not protected when money transfer lock is turned on are deposits or transfers into your Fidelity accounts, check writing and direct debit card or ATM transactions, trading, scheduled RMDs, and personal withdrawals, and bill pay. At the time of this taping, Schwab and Vanguard do not appear to offer a similar feature. Now, if we look at this comparison and total up all the check marks, Fidelity is the clear winner with 20 check marks, followed by Schwab with 13 check marks, and Vanguard with 12 check marks. But as we always say, everyone's financial journey is different. So this overview table alone can't tell us everything, which is a great segue into the next part of today's discussion. Which one might you want to start with as a beginner? And is it worth moving your existing brokerage account elsewhere if you're further along in your financial journey? Before I start answering these questions, I want to be very clear. Fidelity, Schwab, and Vanguard are all behemoths in the industry and household names in their own right, meaning they are all good firms and safe in my mind, as I touched upon earlier. I don't think you can really go wrong with any of these big three here, but perhaps you can get it just a little bit more right for you personally, depending on what you're after. If we were starting our financial journey today, we would still choose Fidelity all over again. And when most folks ask us where they should open their brokerage account, Fidelity is the name that I usually give them as a starting point, unless they have specific circumstances. For example, if they're day traders, international investors, crypto-focused, etc. As you can see from this table, Fidelity is just the best overall across our 7 comparison categories, which is especially important if you're just starting to invest or are undecided and trying to figure out what matters most to you. Is it having everything in one place? Or might it just be overall fees and expenses, or perhaps customer service, or the technology and security? Also, unlike with Schwab and Vanguard, at least you know that if you open a brokerage account with Fidelity to test the waters, there's no charge to close it and transfer out your assets, at least none that we're aware of at the time of this taping, unless it's a retirement account. That said, and as an example, you may want to choose Vanguard if you're a long-term passive investor who places a premium on their low-cost index funds and higher-yielding cash sweep or core position, and you don't really care about the bells and whistles like around-the-clock customer service, a more modern website, and a fancy mobile app. And you may want to choose Schwab if you're a more active investor and or trader who does prioritize their customer service and a better user interface, tools, and research, and you don't care so much about the low yields that they offer on uninvested cash, either because you don't keep much uninvested cash with them anyway, or because you've gotten used to moving the excess cash in your Schwab account to higher yielding money market or short dated bond funds. Again, if higher yields are what you're searching for, or if you want to see what others like you might be buying opportunistically right now, whether that's 7% bonds, preferred stock, international assets, covered calls, or something else altogether, come on over and join our VIP investment club, where we have regular conversations like these every day. Check out the links below this video or visit our website at www.diamondnestegg.com after this video and click on this yellow private VIP investment club button to learn more and join our member discussions and lives. So ultimately, Whether or not it's worth it to move from one brokerage company to another is a very personal decision and will depend on whether you feel the added benefits of the new broker sufficiently justify the time and effort you'll have to put into opening new accounts, transferring the assets over, and learning a new platform. So take us, for example. I opened a solo Roth 401k years ago with E-Trade. My preference would have been to do it with Fidelity, but they didn't offer it at that time. In fact, E-Trade was the only big-name brokerage firm that offered solo Roth 401ks back then. Well, Fidelity did finally launch a solo Roth 401k sometime after I opened mine with E-Trade. And even though in all these categories that we just compared, Fidelity would score higher than E-Trade, my solo Roth 401k is still with E-Trade because we just don't want to invest the time and energy to fill out 30 plus pages of paperwork to do the transfer. Yes, Fidelity is best overall, but E-Trade is good enough. And sometimes good enough is, well, enough. You have this comparison table now, as well as our perspective. So at this point, it's up to you to decide whether your broker is good enough, or if there's something here on this comparison table that stands out for you and would inspire you to choose differently. Curious minds want to know, does anything on this comparison table surprise you? Or is this pretty much what you had expected? And there's nothing that says you have to have all your money with one brokerage firm, by the way. Having all your investments in one place does make things easier to manage. But I know that many of our VIP members and Diamond NestEgg Super Savers have their accounts with at least 2 brokers. Some even with all 3. Don't put all your eggs in one basket, as the saying goes. For example, some will have their low-cost equity index funds, ETFs, and individual stock holdings with one company, and then buy their bonds from another, which is a great segue into the next part of today's discussion. What are some specific considerations for bond investors? So, many of our Diamond NestEgg regulars already know that you can buy individual new issue T-bills, notes, and bonds at auction from Fidelity, Schwab, and Vanguard, as well as from other leading brokerage firms, and usually for as little as $1,000 per transaction. For our Schwab folks, I wanted to also share a message that one of our Diamond NestEgg Super Savers, Finnegan, sent us earlier this year. Treasury Auto Roll at Schwab now works like it does at Fidelity and Treasury Direct, meaning without the historical 1-week gap between the time that the old Treasury matures and the new one is issued. According to the Schwab email that Finnegan sent us, beginning on February 6th, 2026, Schwab will begin purchasing new treasuries at auction before the maturity date, so that the settlement date of the new treasury buy coincides with the maturity date of the maturing security. This change is intended to keep your money invested in treasury investments throughout the rollover process. So that's good news, right? But let's say that you've moved beyond individual treasuries because you're now ready to take on a bit more risk for a bit more return after having watched all our videos over the years. Here are 5 key broker-specific considerations to note when you move beyond individual treasuries. First, if you buy new issue and secondary market bonds of all types, Fidelity tends to have the largest selection, with anywhere between 100,000 to 250,000 plus different types of treasury, agency, corporate, and municipal bonds available at any given time, which may mean not just a broader choice, but potentially also access to slightly better liquidity and terms in some instances. Schwab's inventory is solid, but smaller than Fidelity's, while Vanguard has the most limited selection. Second, if you primarily buy new issue agency bonds and retail notes, meaning new issue corporate bonds that are sold at par, again, Fidelity may be the easiest for you to navigate, as you can see here on their new issue screen. All you need to do is click on the type of bond you're interested in, and all the available new issues appear below that for you to choose from. Fidelity's fixed income platform offers the easiest and cleanest bond screeners and other fixed income tools, in my mind. Third, If you're mostly interested in new issue corporate bonds beyond retail notes, Schwab may be where you want to go, as they appear to have the largest offering in the space for retail investors. For these type of new issue corporate bonds, which are not necessarily priced at par at issuance, you will usually have to call Schwab's fixed income desk to place your order and then wait to see how much you get allocated. Fourth, for new issue municipal bonds, both Fidelity and Schwab have solid offerings. And fifth, Vanguard does not normally offer new issue agency, corporate, or municipal bonds on their platform. You can generally only buy these types of bonds on the secondary market with them. And remember that the cost for buying secondary market bonds is usually $1 per $1,000 par value across Fidelity, Schwab, and Vanguard at the time of this taping, with minimums and maximums depending on the broker, whereas the cost of buying new issue bonds is typically $0 across all three platforms. So drop a comment below and let me, Marcus, and the community know, which broker are you with? Fidelity, Schwab, Vanguard, or someone else altogether? Have you always been with them? Or did you move over from another company? And what do you like and what do you not like about your brokerage company? And as always, if you want to keep the conversation going, or if you want to bounce some questions and or specific higher yielding investment ideas off of me, Marcus, and our other VIP members as you go through your brokerage assets, then come on over and join our private VIP investment club, where these conversations are happening every day. Remember, our Diamond NestEgg VIP investment club is the ideal place for you if you want to 1. Have an extra pair of eyes for critical investing questions. 2. Get ready for the retirement decisions that lie ahead for yourself or a loved one. 3. Understand how a product works, its benefits, and its risks. 4. Be the first to know about safe and or higher yielding investments. 5. Spot and clearly understand new market trends and issues. 6. Exchange perspectives with a like-minded community. And or 7. Continue your lifelong learning about investing and retirement. If you fall into one, some, or all of these categories, visit our website at www.diamondnestegg.com and click on this yellow Private VIP Investment Club button to learn more and join our member discussions. I've also linked everything below this video for your convenience. All right, Diamond NestEgg members, super savers, and course fans, I hope you enjoyed today's video and learned something new. And see you again very soon with more brand new wealth building content for your financial journey.